Good morning. I am Neelam Jha, ex-Chief Manager and Faculty, Central Bank of India. And our topic today for discussion is the strengthening of US dollar and its impact on Indian rupee. This issue affects each one of us, be an exporter or importer, or someone sending money to their children studying in USA, and most importantly, on a macro scale. The fall in rupee impacts the cost of crude oil, and the ripple effect is increase in transportation costs, which increases the prices of other goods. See, India's import dependency on crude oil is more than 80%. A weaker rupee firstly means expensive imports, which cause a hike in inflation in the country, and secondly, higher import bill worsens the trade deficit. Further, businesses with foreign currency debt, they face steeper repayment costs, and those reliant on imported inputs, they often feel the pressure of narrower profit margins. It is a concern as the Indian rupee is fallen to an all-time low against the US dollar, hovering around rupees 87 for $1, as the investors are seeking refuge in the greenback, that is dollar. So the question arises that why is the dollar strengthening against the rupee? See, the price of any currency in the foreign exchange market is determined by the demand for the currency vis-a-vis its supply. Just as the price of any other product is determined in the marketplace, so when the demand for dollar rises, while its supply does not rise in the same proportion, it causes scarcity in the forex market and the dollar gains. And as far as the exchange rate of the rupee is concerned, it is by and large market determined. But the Reserve Bank of India keeps an eye on the exchange rate of the rupee in nominal as well as real terms and intervenes occasionally to maintain orderly conditions in the market by curbing the excessive volatility. The strengthening of US dollar can be attributed to firstly the high US bond yields, and secondly to the substantial outflow of FPI, that is the foreign portfolio investment. In January alone this year, the FPI outflow was rupees 78,000 crores. A point of concern, right? Well, as the dollar index remains above 108 and the 10-year US bond yield remains above 4.5%, the selling by foreign portfolio investors as well as foreign institutional investors is likely to continue. And now coming to the third important reason for the strengthening of US dollar is the ongoing geopolitical tensions, particularly the Russia-Ukraine conflict and increasing US-China rivalry. It has created a volatile global economic environment. This uncertainty has led to a risk-off sentiment among international investors, prompting them to seek safety in the US dollar denominated assets. Here I would like to share that the Indian rupee depreciated by 3.2% to 87.45 as on 10th of February this year against the US dollar since 6th of November 2024, the day the presidential election results were announced in the US, largely mirroring the 2.4% appreciation in the dollar index during the same period. So, is it simply a one-sided traffic? If you look at the bigger picture, you would find that in reality, the dollar has been strengthening against many currencies. In this context, when we look at the rupee's fall, it is relatively moderate in comparison. The current situation is I would say more like a strong US dollar issue, driven by factors like market expectation of reduced US trade deficits under the new US administration and the safe haven buying of dollar assets. Globally, the US dollar has strengthened against both developed and emerging market currencies, with 12 major economies seeing their currencies depreciate against the greenback in recent months. This dollar appreciation is something that will play out for some time until we see the new US administration's policies, particularly on tariffs, which many fear that it may lead to a full-scale trade war. Now, coming to the available options in the current scenario. The weaker rupee offers some opportunities. Firstly, it provides an export advantage and could boost the export-oriented industries like IT, pharmaceuticals, textiles, automobiles, etc. A weaker rupee can make the Indian exports more competitive in the global market. This can lead to increased demand for Indian goods and services, boosting thereby our export earnings. But for that to happen swiftly, incentives will have to be offered to such industries and suitable trade strategies need to be formulated in their favor. Further, the domestic manufacturing and productivity will have to be further pushed and towards more improvement and production. Secondly, a weaker rupee, it has a remittance benefit for Indians living abroad because their remittances can fetch more in Indian rupees. It can benefit the economy, particularly in regions heavily reliant on remittances. In the longer term, correction of India's currency may be a healthy development, especially if it helps India to boost its fledgling export economy. Because despite the inflationary risk, a falling rupee adds to India's export competitiveness. One of the solutions in this during this depreciation of rupee and the consequent global challenges is to strengthen the domestic economy by improving domestic production and increasing our exports. See, as the imports become costlier, reliance on them needs to be reduced. So the mantra here is increase your exports and reduce your imports. It is a long journey. It's not something that can be done overnight, but we as a nation would need to do this so that our imports are reduced and our exports increase, thereby reducing our trade deficit. So there has to be more push by the government for Make in India projects, Make in India products. But what about us, the common citizens? My suggestion would be simple: be Desi, buy Desi. I repeat, be Desi, buy Desi. That's all for now. Stay connected for our next session. Thank you.